Hey, what's up guys? John here. One of the biggest changes to hit the housing market in the last 100 years just happened. We're seeing not just rents falling and home prices falling, but they're now getting rid of traditional credit scores to buy a home. So many people are saying, hey, I'm going to invest when the market crashes. I know I'm one of those people saying, you know what? I think the market's going to go down. I think there's going to be great opportunities to buy distressed real estate. However, what people aren't really taking into consideration is what Fannie Mae and Freddie Mac just did. And they own a large block of U.S. mortgages, and a lot of other lenders are following suit right now. So if you intend to invest when the market crashes, I'm going to share exactly what's happened right now, because I believe this is going to put a lot of people out of that category of being a buyer in the next couple of years. Please hit the like button. When you hit the like button, YouTube's going to share this content to educate more people about what's really going on in the housing market. Rents are starting to fall across the U.S., and they're set to drop even more in 2023. Now, I believe, the only person that said over a year ago that rents are actually going to fall in America, not continue to increase. A lot of people are saying rents are going to increase. My belief was that what we are likely going to see is a lot of curveballs coming to this housing market that is going to bring out much more supply than what economists and builders and Freds and all these different analytics platforms are coming out with, the data in which they're suggesting. I believe what's ultimately going to happen is we're going to see home sellers that missed the housing market list their homes for rent. We're going to see retirees that thought that they had their retirement tucked away and realized that, inflation, the world's getting more expensive. They don't want to sell their property for fiat currency because they don't know how long that money will last. What are they going to do? They're going to list their home for rent. We're going to see interest rates rise, and as rates rise, what's going to ultimately happen? People are not going to be able to refinance their properties, and if they can't refi their properties, then ultimately, what are they going to do? List it for rent. And ultimately, if they can't list it for rent, they're going to likely list it for sale. Home builders, 1.5 to 1.7 million new homes are coming to market. Interest rates went from 3% to now in the mid 7s. What are those people going to do? Are they going to list it for rent, or are they going to sell it at a massive loss? I think they're going to list it for rent. And then you have a very, very unique situation unfolding right now, as 52% of all employers are getting ready for layoffs. What are they likely going to do? People that lose their job, they're going to list their home for rent, which I think is probably going to be more likely because a lot of people simply won't have the equity in their property to sell it. So what are they going to do? Bring out more supply. Then you're going to have a lot of people bringing in roommates and doing whatever they can possibly do to bring in revenue. So there's going to be so many people that would have traditionally sold, but they're going to start listing their properties for rent. All of which is going to be a real big problem for landlords that have purchased properties over the last couple of years, baking in 10 or 20% annual rent growth and very low interest rates, not factoring in for these uncertain times. So I believe we're going to see rents really come down in a very, very big way. And you have to realize that people are buying, let's say, a apartment building and rents just grew 20% and they bought it at a 5% return. And now what's ultimately going to happen is they got a 3, 5, or 7 year ARM, 3, 5, 7 year fixed rate mortgage that's going to adjust. What's ultimately going to happen if rents are falling and rates are rising and insurance is rising, those landlords are going to be in very big trouble. That's what's ultimately going to happen. We're going to see a lot of these landlords walk away from their properties because these assets are not assets in which they guarantee. The asset is the guarantor. So what's ultimately going to happen? If there's no revenue coming in from the building, they're just going to walk away and the bank's going to take the property. So take a look at this. If your rent spike this year, as it did for many Americans, 2023 could give you a reason to celebrate. Tom Lawler, a former Fannie Mae economist, wrote in a recent real estate newsletter that he expects rents across the country to not just slow down, but to experience a rare actual decline in real dollar amounts next year. And those declines are likely to spread and accelerate in 2023. In fact, rents across the U.S. have already started to decline in some markets. Data shows that the third quarter of 2022, national asking rents went down by 0.4%, reflecting a shift from a year ago when demand drove prices to historical highs. Lawler's forecast hinges on the fact that U.S. builders are still ramping up construction despite there being fewer renters who want and actually can afford new rental units. It's a rare storyline of excess supply in the housing market that is weighed down by shortages for years, financial and economic fear among Americans also driving declines. Says the CEO of Zumper, an online rental database. We saw historical levels in migration through the pandemic as people switched from working from home to reimagining their living situations, he said in a statement. Now a turbulent, unpredictable economy causing fear of recession. Migrations are slowing, occupancy rates are falling, and rent prices are following suit. Well, it's obvious. Right now, housing market pending home sales plunged for the fourth straight month. Pending home sales dropped more than expected in September. I mean, this is what's happening. But here's what a lot of people are not forecasting. This new FICO 10T model, it's going to change everything. This is so huge. And it's breaking news. It's just coming out. I mean, they've been talking about this for years, but now it's implemented. Here's what this actually looks like. They say it's going to be more inclusive and help people, become homeowners. But the fact is, it's the complete opposite of that. It's actually going to make things so much more challenging to get a mortgage. So take a look at this. It says the FHFA approved 2 credit scoring models for Fannie Mae and Freddie Mac, and it could make it easier to buy a home. Attention future homeowners, of buying a home may have gotten a little easier. Yesterday, the Federal Housing Finance Agency approved 2 new credit scoring models for use by Fannie Mae and Freddie Mac, 2 government-sponsored enterprises that guarantee most of the mortgages made in America. Both agencies are now authorized to use the new FICO 10T credit score model and Vantage Score 4.0 credit score model, as opposed to relying on the classic FICO scoring model that has been standard for nearly 2 decades. So they're basically they're moving out of the FICO traditional, Experian, TransUnion, Equifax models, and they're moving into this FICO 10T for underwriting for mortgages. The goal is that these 2 models will help improve accuracy by taking into account borrowers' full repayment history and factoring in rent payments, utilities, and telecom payments. So, before, what ultimately a lot of buyers did was they might carry a lot of credit card debt. And then ultimately, when they're about to buy a property, they'll make a huge pay down on their credit card balances, bring down their utilization, their credit score will spike, they'll get approved for a better mortgage, and then after they close on that home loan, then they'll start building up their credit card debt again. However, that is no longer going to be allowed. In addition to these new scoring models, the FHFA announced a change in credit score reporting requirements for lenders. Currently, Freddie Mac and Fannie Mae require that lenders provide credit reports from all 3 consumer reporting agencies, TransUnion, Equifax, Experian. Instead, lenders will have to provide credit reports from just 2 of those agencies. Both FICO and Vantage scores provide consumers with 3-digit scores based on information in their credit report. Lenders look at this. Obviously, if you have a high credit score, 740, 800 and above, you're going to get a very favorable interest rate, and you're likely going to get access to more money. And ultimately, if you have bad credit, 550, 600, 650, you're either going to get completely rejected and not get the loan, or if you do, your interest rate is going to be very, very high, and they're going to lend you less money because they deem you or that borrower as more risky. And so because of that, they need to really take into account that type of risk. However, these changes are going to look like this. So the FICO 10T represents a new take on credit scoring with the use of trended data, which looks at how consumers have managed their financial accounts over the past 24 months or longer, including things such as whether they carried a balance from month to month or consolidated their debts during that period. So remember when they said, utility bills you can put off to the side, rent payments, you can, these bills are optional. Now they're going to start using that information to see who actually paid. So if you want to buy in the next year, the next 2 years, and that's your goal, you really want to invest, now is the time to really look at your accounts, really figure out what you can possibly do to increase your score and to really clean everything up. Because what's ultimately going to happen is I think there's going to be huge investing opportunities coming, but if there was a situation in which you carried a lot of credit card debt or maybe defaulted on some payments and you're hoping just to clean it up before you go buy, you might get rejected just because of this, this new 24-month trending data that they're going to now associate with home loans. This is going to be really big. This is going to be huge. I think a lot of people simply aren't taking this into consideration. Credit scores are going to be so important when getting loans. The reason being is you're going to start seeing a lot of banks, you're going to start seeing a lot of lenders losing an absolute fortune over the next couple of years by all of these loans that they issued out, all these people losing their jobs, all these people just defaulting. They're going to start paying attention to every single detail, every bit of data on every consumer that gets a loan. So if you want to get a loan, make sure you have incredible credit. Make sure you really, really position yourself for success, because the worst thing possible, in the finance world anyway, would be for one to see a deal that's worth, let's say, $500,000 and you have the opportunity to buy it for $250,000, but you need a loan for $200,000, and they say, you know what? No, this isn't going to work. And then you miss out on a huge investing opportunity. This FICO 10T, it's going to be really important. Now's the time to fix your credit. Now is the time. We'd love to give you a free consultation. Go to CashNow.Video and you can get a free consultation. It'll take about 10 seconds to put your information in, and you'll get a call from likely Erica today. But this is huge. What do you think about this? Drop below, hit the like button, subscribe here, and subscribe to my second channel. Also LinkedIn, Twitter, Instagram, TikTok. Subscribe over there as well in the banner, and I'll catch you guys in the next video.